Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to respond sort of to another comment from one of our viewers, a question that was asked, which is really, I've made some comments in previous videos about how I have zero interest in looking at 7 and 8% a year returns. I think they're trash. I think you shouldn't be looking at them. And they say, okay, well, great. How do you get higher returns than that? So today I'm going to give you 5 ways that you can invest in 2021 to get somewhere in the kind of like 12 to 30% a year range, okay? And these are going to be ones that we're specifically targeting as being solid investments, okay? So by contrast, in some previous videos, I've mentioned, for instance, crypto. And I think it was early December, I mentioned kind of the DeFi projects that I bought into. I went through, I said, hey, SNX, well, SNX since then is up 3.5x. I said Uniswap, it's up 3x from then. I mentioned Band is up about 50% from then. Dog hasn't really done much. It did spike up, then it went back down. And I mentioned Aave, which is also 3x. So, in a month and a half, those are pretty good returns across the portfolio. That's like, 2.5x or something. It's going pretty well. Now, I haven't sold out yet, so it may go down a bunch, or it may continue to go up a bunch. We will find out. You don't know until you sell. But that being said, these 5 things are not going to be things like that. These are going to be pretty stable, solid investments. As a result, they don't have the possibility of giving you, 10x or something like that. That can't happen. But on the other hand, you're pretty stable in them. So before we get into that, if you haven't already, please smash the subscribe button, hit the notification bell to make sure you don't miss out on any of our future content. We try to produce great content for you every single day. And if you're at all interested in these subjects of, how to invest internationally, how to structure your investments to pay the lowest amount of tax, how to structure your business to pay the lowest legal amount of tax, whether you want to move abroad or whether you want to stay locally, how to get residency permits, what residency permit might be best for you, what citizenships, if you're wanting to get a second citizenship, which ones are good for you, how to get them, including unofficial citizenship options, citizenship by investment programs, opening companies, offshore bank accounts, please reach out to me. You can book a call at clarity.fm/Michael Rosmer. There's a link in the description below, or you can visit our websites, offshorecitizen.net and offshorecapitalist.com, and you can send us a message. All right, let's dive in. Okay, so as I was saying, 5 investments. Number 1, if you were to go and you were to do private loans, private secured loans, okay, this is one that has worked out pretty well for me. I'm going to give you guys an example in a second of one that was just brought to me a week, 2 weeks ago, something like that. But these are basically where you're lending some money to some sort of a company, some sort of a project, and you're getting some sort of security in return. Now, the security is really important because that's what's protecting your downside, right? Otherwise, you're lending some money, maybe they go belly up, maybe, they don't pay you, something like that. It's a real pain. We don't want to deal with that. We want to be in a situation where the collateral is worth more than what it is that we're lending. So for instance, I have a number of times over many years done equipment financing for people, okay? So this is some business needs to purchase some equipment, and there's a period of time that by getting that equipment sooner, it's valuable to them. The equipment, as well as maybe I'm grabbing some extra equipment as security, I want to have at least 50% protection, right? Because the value of equipment can go down. I want insurance, I want some control. There's different things that I want to do to protect myself. And if you guys have questions about that, again, reach out to me because it can get sort of complex, but it's not that bad. The point is just like you have to understand how to structure it so that you're safe, right? In cases like this, you can expect easily 12, 14% up to around 24% a year. Theoretically, you could have higher, but I don't typically see that. That's usually the range. So to give you an example of a deal that was brought to me by a client, a very good friend, great investor. He does these deals all the time, about a week, 2 weeks ago, something like that. This was a deal in North London. It was a real estate project, and basically you were able to borrow or lend money for 2 years at 28.8% per year for 2 years. Simple interest, didn't compound. It was secured by real estate at about 75% value, so you had a pretty good margin of safety in there, right? If it's theoretically possible, of course, that things could go way down and the project could drag out and some certain things like that could happen, but you're pretty solid on this deal. He's a very good investor, so just the fact that I would be co-investing with him was great, right? And 20.8% is pretty good. Now, what do I want to tell you guys about these types of deals and all these future deals, okay, is when I run into people who they kind of like don't realize that deals like that are out there, there's probably three things they're not doing. One, they're not looking wide enough, okay? Like if you're willing to look out, maybe in your little market, your little bubble, your little area, there aren't opportunities. But there's a lot of opportunities in the world, okay? So being able to look broader is very, very helpful. So for instance, a deal like this one in London was not available in the US, and there's some reasons for that due to basically capital being really cheap and accessible in the US, and some changes in the Basel III bank regulations, which kind of prevented some of the lending from the senior debt lenders in UK that opened up some opportunities there. Okay, so that's one thing that is worth noting. The second is people just don't dig deep enough, right? Like these are not, if somebody's just marketing the deal to everybody, you're probably not going to get that good of a deal, okay? Like you kind of have to be willing to dig. And you want to put yourself in a position where if a deal comes up, you're prepared to act, right? If that is the case, you will start to develop a reputation as somebody who can do deals, and deals will come to you. And then you can have your criteria and you can start to work on this and do fairly well, okay? Number three is people don't negotiate, okay? You need to negotiate these deals. There's very often, if somebody comes to you and they say, hey, I'm willing to pay you 9%, you're like, look, you know, I don't do it for less than 12, you know? In the case of this deal with this friend of mine, I think they had started at 15% and he'd negotiated it up to 20.8%, right? So, you know, that was over a long period of time and a bunch of work and going back and forth and all this stuff. But the point is, you can get these good deals if you're willing to look broadly, dig deeply, be ready to execute, and be in a situation where you negotiate the deal, okay? And that's gonna go for all of these. Number two, okay? The second one are hands-off real estate deals. So the commenter who kind of spurred this whole video, and thank you by the way, kind of mentioned, he was like, hey, listen, you know what? Like real estate is a pain in the ass. Yeah, it can be a pain in the ass. I've owned real estate that I've managed myself. My family's owned real estate we've managed ourselves, etc. You know, it can be a pain in the ass to deal with. And do you really want to deal with that? You know, personally, for the few hundred to, you know, a few $1,000s a month, it's just not worth my time to go and deal with that sort of thing. But there are plenty of completely 100% hands-off deals that you can do where they're self-managed or they're managed by like another party who's involved in the deal, and you're just putting in money and then taking checks, okay? That is, to me, kind of the optimal scenario. Again, if you don't know where these are, reach out to me. I'm happy to put you in touch with. There's a bunch of groups like this that are very solid, that consistently do deals, and you should probably, in a cash-on-cash return basis, be getting, just in cash flow, somewhere between 12 to, I would say, like 25% return, okay? You can maybe do a little bit better. I'd be skeptical about if you're doing better, but it's possible. Actually, I have seen it in certain cases, such as in Cuba, which is a whole other different environment, right? Totally different, but potentially you could do that, right? So I would expect kind of that normally 12 to 18% range. And then there's usually some equity appreciation possibilities on top of that, okay? So that's pretty decent, right? Pretty decent if you can do those numbers. Number three, film finance. I've done a video on this in the past, and this is more complex than the first two because you have to be able to evaluate the deals a little bit. And so kind of what you want is a good deal flow source. So again, reach out to me if you're interested, and you know, I'm happy to connect you with people that I know in the space. But what you typically want here is you typically want small productions. Okay, so these are not glamorous productions. These are usually the way that they work. What causes it to work for you is that you're last money in, first money out, and the way that the deal is financed is based on you have a lot of like pre-sales, you have a lot of government, like maybe government grants, as well as tax credits, etc., that allow there just to be like this small slice that needs to be covered that you cover, and it's rolling over quite quickly, okay? So in these scenarios, I would say it's pretty typical for you to get around, let's say, 20% as a fixed rate of return, okay? Now, normally that's probably gonna take, you know, 12 to 24 months to turn over, depending on what's going on there. Could be a little bit less, could be a little bit longer. That's again where, you know, who does the productions and things is important. But then on top of that, you'll get a percentage of royalties on the back end. and you could negotiate, something potentially better. I mean, directors are not great at negotiating in most cases, so you can potentially negotiate pretty good deals if you show up at the right time and you're able to execute. And, it can be kind of cool, right? So those you can set up certainly to be quite safe. Again, pretty good return, right? You're talking about maybe on an annualized basis, you're talking 12 to 15, on the very high end, 18%. Again, maybe you could negotiate better, but that's kind of what I'm used to seeing. But then you also get this royalty piece, which is once you've already got your money back over a period of, say, 10 years, you can be getting some extra income, and that extra income potentially could add up to a bunch, or it could add up to nothing. You're not really too concerned. That's like a bonus, right? It's basically free extra money. You already made an okay return off the initial investment. So again, that's nice because it's non-correlated to other things and quite safe and quite solid. Number 4, Arbitrage Fund. So there's a very specific one that a friend of mine runs out of Luxembourg. I would say, so it's not a fixed return. So you don't actually know what you're necessarily getting because it's based on the arbitrage opportunities, but it's super, super safe in terms of like money is very solid. You're 100% liquid, which means you can get in and out very quickly, which is nice if some other opportunity comes up. It's cash flow, like weekly sort of thing, which is fantastic. And you're talking in that case, depending on the market, they average like around 15%. Okay, it could be high single digits, and maybe you get really lucky with the market, and it goes up into the 20 some odd %, right? But the bottom line is somewhere in that range. So that's to me a really good example of something that, hey, listen, you can put some money in, there's a good opportunity, you can get some cash flow off that, it's solid, it's taken care of, somebody else is dealing with it, and if you need the money, it's available pretty quickly because it's always liquid based on the nature of how it works. So just quick explanation for how do arbitrage funds work. They basically take advantage of the differences in price on multiple markets. So they basically have computers that scan, and they have accounts with these different ones, and say there's a difference in price between this asset here and this asset here, they'll simultaneously buy it here and sell it here. And there's going to be like a small little amount that they pick up as a difference, and they just do that over and over and over again, lots and lots of times. And so it's like they're in and out of the market for so little period of time because it's just like execute, that the risk is very, very low. The returns aren't very high on any of those transactions either, but the number of transactions add up to giving a decent return. So again, something good. Again, if you have questions, you can reach out to me. The 5th one, this one's a little bit complicated, or I don't know. We'll call it complicated. It's what's called debt equity financing. Okay, I think there's some fancy name for it that I can't remember off the top of my head, but I refer to it as debt equity financing. I see these deals typically in New York. They're based on public companies. What happens is the public company wants to borrow money, and rather than you just lending the money to them as a loan, what you're doing is you're lending a loan, but it's convertible to public stock at a discount to the current to whatever the current share price is. Okay, and so you're actually in and out fairly quickly, because what happens is, let's say they want to borrow $5 million. Okay, I'm like, okay, great, we need $5 million of financing. We're gonna do it on these terms. You're gonna do an analysis, and it's probably not you, it's probably the person who's putting the deal together, right? But potentially whoever, however that works. Somebody's gonna do the calculation where they're gonna look at the daily trading volume of the stock, and they're gonna say, okay, great, we can realistically sell X amount per day. Let's just say, for instance, it was $20,000 a day without knocking the price of the stock down. And you're not planning on getting paid back through loan repayments. Instead, what you're doing is immediately you're going to start converting. 20,000 today, 20,000 next day, and you're just going to convert. You're going to get it at a discount, right? And you're going to immediately liquidate. And you're going to make a tiny spread, well, not tiny, probably a decent spread actually, a decent spread, and you're going to do it over and over and over and over and over again until your loan is completely paid back by converting that money. And so those are very interesting deals that, again, are quite safe. They offer potentially pretty good returns. Now, those, if you're thinking about kind of the volume of money that you can deploy in those, usually it's kind of a minimum 7 figures, but it's hard to do 8 figures, just kind of the range, like the size of those deals. So a lot of these you can look at, I would say you're typically looking at 6 figures. If you're trying to invest less than that, I mean, the due diligence process doesn't really make sense. So most of these, like the film deals that I look at, are typically 6 figures, sometimes into kind of 6 figures into the low 7 figures per an investment. If you're talking about the real estate deals, you're talking about 6 figures into the, I mean, there you could get actually into, 7, maybe 8 figures in those cases. You could go and you could look at something like the private loans. Usually the private loans are, those can vary, but usually you're talking about low 7 figures down to 6 figures. Again, these are not really 5-figure deals, and it's really hard to deploy, 8 figures in a deal and get those kinds of returns, right? So that's something, and the arbitrage fund, similar sort of thing, right? You're talking about, 250 grand up to, a few million is kind of the range that you can deploy. And the reason is just there's only so many opportunities that can be played with. And so then you kind of exhaust those and you have to go on to the next deal. So anyway, those are the 5 options that will work for you. Obviously, you can go and you can buy crypto and stocks and all these kinds of things, and you can potentially do much better. But those also have the downsides. These are trying to give you some idea of opportunities that are out there today in the market that you could invest money and certainly do a lot better than 7 or 8%, which I find kind of a pitiful rate of return. And yeah, hopefully this is helpful to you. So if you liked the video, please give it a thumbs up. If you didn't, please comment below, tell me why. Really appreciate the feedback. Please, if you haven't already, smash the subscribe button, hit the notification bell, share the video with your friends. If it's, we really appreciate sharing. We really appreciate people who join us. And definitely, if you have questions about any of this, you'd like help with your international investing, your international tax planning, asset protection, residencies, citizenships, company formations, bank accounts, reach out to me, clarity.fm/Michael Rosmer. There's a link below, or visit our websites, offshorecitizen.net, offshorecapitalist.com. I'm going to see you guys on the next video.